Now you can start.
Good evening to all the members who are participating in this webinar on refresher course on GST. Good evening, friends. I'm Narayanan, Secretary of the SIRC of ICAI. As you are aware, on 17th of February, the new committee has been reconstituted and the new office bearers elected, and I'm the Secretary for the year 2022-23. So I welcome on behalf of the SIRC, Executive Committee members and all the Regional Council members for this two-day refresher course on GST. Today we have CA Shankara Narayanan, who is a member in practice from Chennai, to address on the topic of GST precaution pointers. And tomorrow we have a topic of GST departmental audit, legal and practical aspects. And the speaker of tomorrow's session is CA P. Ganesh Prabhu. He is also from Chennai. I'm sure these two gentlemen would share their rich experience, and members would be benefited by their active interaction and deliberations on this topic. Coming to today's topic, GST precaution pointers. CA Shankara Narayanan is a chartered accountant and a cost accountant with more than 1.5 decades of experience in finance, taxation, compliances spanning across diverse sectors, including banking, service sector, and manufacturing sector, with specialization in indirect taxes. He is a member of the GST study group of ICAI. He has contributed as a part of ICAI team in charge of preparing and updating of background material of GST. He is a master trainer of GST, has been a faculty in the Institute of Chartered Accountants of India. He's trained more than 1,200 chartered accountants across India in GST law and practice. He's also trained more than 4,500 finance and accounting professionals across India on indirect taxes and GST. He's a member of the training team of ICT engaged in GST knowledge dissemination, part of Niti Aayog initiative. He's been a member of the Governing Council and Secretary of International Chamber of Indirect Tax Professionals. In addition to this, he's also authored a book titled Gain Smartly Through CENVAT Credit Rules 2004. And he's been a regular trainer and a speaker at the Institute of Chartered Accountants of India, Cost Accountants of India, Company Secretaries of India, and also he's trained officers of Commercial Tax, Staff Training Institute, and National Academy of Customs, Excise and Narcotics, Chennai. He's been the founding partner of the firm GP, VS and Associates Chennai, based out at Chennai, and he's heading the Department of Indirect Taxes, Compliance, Advisory and Litigation vertical. With this very brief profile, I welcome CA Shankara Narayanan to this webinar, and I would request sir you to take your presentation through. Thank you very much.
Thank you, sir. So good evening to all the esteemed members who have joined for this refresher course on GST, where today's discussion is going to be on the closure of financial year 2021-22 and what are all the key pointers from a GST perspective. So let me take a moment to share my screen.
Yes, sir, visible, sir.
Yeah, I hope it is visible.
Yes, sir, yes.
Yeah. So the aspect that we are going to explore, the precautions and pointers, is focused or prepared with those surprises that one gets to see in the GST, from the GST perspective, when we do a statutory audit. The idea is to curtail any such surprises and also to cover in our audit program, in our part of our financial year closure, whatever those which we have experienced in the past, either something which we have practically come across or those situations where departmental audits or any proceedings by the department, because of that only we came to know that such a thing exists and we need to take care of it. So those are the backgrounds from which this pointers and precautions have been prepared. So with that in context, let's look at the basic thing that which we are supposed to do while preparing, especially with respect to a client who is having multi-state presence. From a GST perspective, the financial year closure, how it should happen. I've taken a simple example of a client who is located in 3 states, who has got 3 registrations basically. So let's say he has got a registration in the state of Tamil Nadu, where he has got turnover as well as outward liability, and he has also got presence in the state of Maharashtra, as well as he has got a presence in the state of Karnataka. Now, when we look at it, might look and sound very simple, because a sum of these would mean that we have got their total turnover. Technically, this is not correct from a GST perspective, because a totaling of these 3 would only mean that we are missing a critical piece, which is the transactions which in GST terms we call it as deemed supply. So what is a deemed supply? Those are the ones which happen within the organization. Let's say Tamil Nadu has done stock transfer to Maharashtra, and Maharashtra done stock transfer to Tamil Nadu or Karnataka, or inter-office invoices have been raised. Now these will have to be eliminated to arrive at the overall turnover. Now this overall turnover, overall tax liability, overall P&L is what we disclose in our audited books of accounts. These eliminations will not figure there, but when we do a GST reconciliation, state-wise your tax liability would mean that that is what need to be paid, but that turnover that is disclosed in each and every state, if I total it, that will not match with my P&L turnover. That should not match with my P&L turnover, where I do have deemed supplies, transactions which attract GST but which are not considered as sale. This can happen in both the legs. So the eliminations will have to be done from a purchase transaction leg as well as on an outward transaction leg. Only then the finalization should happen. Now this is something which is very basic, and out of practical experience, what we have seen is in the last 3 years, some of the cases we did come across where we are the GST auditors, we did come across that this elimination had not happened. The total turnover had been considered, meaning all the 3 states together, and that total has been published as their P&L. That is the total turnover that is disclosed in their income statement, which is wrong, because to that extent your outward turnover is overstated. There is an argument saying that no, my outward turnover is overstated. At the same time, my purchase is also overstated. Hence, it has a balancing effect. Agreed. Numerically, we are right, but technically it is wrong, because I cannot be reporting a transaction just because it is there on my debit side. On the credit side also, it should have got eliminated. So this is one of the very basic steps that we should ensure to have the finalized books of accounts. Now here, the other critical element which emerges from here, which we are supposed to do from a GST perspective, is GST registration wise books of accounts must be maintained. It is a mandatory requirement under section 36 read with rule 56. We are supposed to have books of accounts state wise. So if you are not having books of accounts state wise, then it is not considered as a compliance at all. Hence, from that perspective also, we should ensure that the organization is able to see 3 different trial balances, at least, if not P&L, at least 3 different trial balances, and then an elimination, and then only we arrive at the final trial balance with which we will be able to prepare an overall reconciliation. So this is how we are supposed to prepare the basic set of the financial statements. Now this is one learning which we have had in the past, which should be put in place for 21-22. And then the next aspect with respect to what are documentations that one should check. When I am convinced as an auditor that I have checked those or these documentations are ready, then only we are prepared for a departmental audit or departmental inquiry. Then these are the documentations that we should check. Now these documentations are, again, going back to rule 56 read with section 36, we have managed to list out that these are the documentations the officers can by and large ask us to produce apart from our financial books of accounts. which is required state-wise. So these documentations that they would ask us generally would include the production records, how much has been produced during this period, or if you're a manufacturer or production oriented organization, you can produce that record of what is the opening balance of the work in progress, what is the opening balance of finished goods today, and then how much has been produced today, how much is the output, and how much is the closing balance. That record will have to be maintained. Stock of all your inputs, direct material and indirect material, that has to be maintained. That inventory shall have to be reported. And if you are a service provider, the services supply register shall have to be maintained separately. And what is commonly known to all of us is the sales register and purchase register. These two are mandatory, where we can add additional columns and make it into a comprehensive document. How is that possible? We can add in a purchase register, purchases are those which I procure. But all that I procure, one, need not have GST. Two, even if it is having GST, I may be eligible for ITC, I may not be eligible for ITC. Hence, in a purchase register, if you can populate and bring the ITC column also, which need not be there for every line item in the purchase register, but it is there for only those items on which I am availing input tax credit, then that will give a comprehensive coverage in terms of covering both the requirements of a purchase register as well as the input tax credit availed data. The other corresponding register which I need to maintain and I have to disclose to the officers is the sales register or the outward register. In that outward register, if I can populate the output tax liability as well, then that would become comprehensive in terms of disclosing what is my outward turnover that is reported as well as the corresponding tax that is payable on it. Together it will cater to that requirement. And then I need to prepare two separate registers, one for my import of goods or services, one for my export of goods or services. Import of goods or services register shall always be corroborated with my bill of entries in case of goods. And in case of my services, whenever it is import of service, both from an income tax as well as GST angle, there are corroborations that can be done. If it is an import of service, under income tax, 15CA, 15CB would obviously find a place. From a GST perspective, whether reverse charge on the import of service has been paid or not shall have to be identified. Hence, this register is not just for the purpose of completing our audit, it is also acting as an evidence or the identification of what all is possible in a transaction. And when it comes to exports, export of goods or services register shall have to be maintained. There again, whatever is finding a place in export of goods or services register, shipping bills, the corresponding shipping bills details is required to be able to identify and tell whether we have got all the exports covered in that register and whether the required documentation exists with us. And with respect to services that are exported, we should be able to substantiate with the FIRC or EBRC reference, because it is mandatory even for services that the foreign currency realization details shall have to be maintained, because under 2 subsection 6 of the IGST Act, the definition of export of service itself has a condition inbuilt that only on realization of convertible foreign exchange it is considered to be an export of service. Hence, to prove that and to ensure that we have comprehensively covered all that the assessee is disclosed as export of service, this register would be a very important register or a documentation to be maintained. And then comes the liability side as well as an ITC angle, which is the RCM register. When I say RCM register, there are 2 kinds of RCM register. One is very common. The other one is there as part of GST's requirement, but may not be common. Now we'll first look at that RCM register which is common. The RCM register which is common, which is generally known to all of us, is on my inward supplies when I am liable to pay GST under reverse charge. On my inward supplies, when I am liable to pay GST and a reverse charge, those will have to be accounted and kept in a separate register, which is what is my RCM register. Whereas I might be in a business where on my outward supplies, it is not on my inward supply, on my outward supplies I'm liable to pay. I'm not liable to pay GST. It is my recipient who is liable to pay GST under reverse charge. Then for that also I need to maintain a separate register, because technically it is part of my outward supply, but on that I am not liable to pay GST. My recipient is liable to pay GST. Classic example would be a lawyer who is registered under GST, or a GTA who is registered under GST, but who is also doing other activities other than being a GTA. Whatever services I am rendering as a GTA, I will give invoices, but my recipient will only pay GST under reverse charge. So that will have to be maintained separately. Whereas any other services that which I am doing, or goods that I am supplying, on which I am liable to pay GST, will form part of my outward supply. So this is a lesser known or not very popular or not very common, but still that is an RCM register that needs to be maintained if it is applicable for your type of business. And then the last type of register or document that we need to maintain is with respect to all the advances that have been received, as well as all the advances that have been paid during the year. The advances that which I received during the year, if I am going to be a service provider, there is an impact of GST. We will see that in detail a little later. Why would advances paid register would have to be maintained by me? What is the need for it? The advances paid register is a key place for identifying time of supply in case of reverse charges. Section 13 subsection 3 time of supply states that in case of reverse charges also, especially in case of services, how to identify the time of supply. The time of supply shall be the date of payment or the day following the 60th day from the date of invoice, whichever is earlier. Suppose I pay advance to my lawyer for legal fees, or I pay advance to a goods transport agency. My liability to pay GST will not wait until he raises an invoice. My liability to pay GST would arise. The time of supply would arise the time when I have taken the advance and I have paid the advance. So this is a case where I pay the advance. I need to maintain the advance paid register as well to prove to the officers that whenever I made the advance payment to an RCM supplier, I have paid reverse charge. But other advances that I have paid to my suppliers, who are not coming under RCM, there is no need for me to pay any GST. To substantiate this point, this register shall have to be maintained. So these are broadly the documentation part, the registers which are apart from the financial books of accounts, if maintained, will largely cater to the needs of the department when they are stepping into our premises for an audit or an inspection. Hence, section 36 read with rule 56 would make us maintain this. What are all the columnar data that needs to be maintained inside this register? That is left to our imagination. What is the basic data that would be required? We'll have to maintain, like for example, the GST number of the person involved, his name, maybe the document date, payment date in some of the cases. Likewise, we have to maintain all that would be required to substantiate the transaction. To that micro level, the documentation requirement is not specified in the GST law, but at least on this broader indication, we need to maintain. So the pointer is given. This is what is the document that needs to be maintained, or the record that we'll have to keep in our hands. Ensure that this is in place. And moving to the next aspect, again, sticking to the documentation angle only, is the transaction specific documentation. Now, most of us would have experienced the pre-GST regime where we had this concept of C form, H form, I form, all that were part of our documentations required for the purpose of VAT or CST. Once GST came, we thought that the documentation requirement for proving a transaction is not going to be physical. The documentations are, if at all documentations are required, we thought the documentation requirement will never be there. And even if it is there, our understanding was they will be online. But unfortunately, there are transactions in GST also similar to C-form transactions where we need to prove in terms of that transaction is the transaction which is contemplated under a particular notification. And I have availed the benefit of the notification. If we are to prove the transaction as the one which is falling under that notification, then we are supposed to be in possession of the requisite documentation. The common such notifications which we have come across that one has to be checking whether the assessee has involved in those transactions is what I'm going to share now. One such notification would be the deemed export transactions, which are covered under notification number 48/2017 CGST notification dated October 2017. Four different types of transactions are getting covered here. One is the supply to an EOU. The other one is supply to a person who is holding advance authorization license, or the supply that is made to a person who is holding an EPCG license. When I make supplies to them against an invalidation letter in case of advance authorization or EPCG license, or in case of an EOU supply, if he is able to provide me the proof that he is an EOU on the form A that he is mandatorily supposed to provide, only against the strength of the documentations I can call the transaction as a deemed export transaction. And these deemed export transactions shall have to be reported in table 6C of my GSTR1. So for it to find a place there and for it to find a place in my GSTR9 as a deemed export transaction, I must have the substantiating documents in my hand. So one such transactions requiring documentation, deemed export. The second such notification based transaction where we need to provide the documentation to the officers, hence we need to collect it from our customers, is a merchant exporter transaction. In other words, notification number 40/2017. Whenever I am making a supply to a person who holds himself out as a merchant exporter, in other words, he says that please supply to me, I will only export the goods, I will not even touch the goods, I will just merely take it from you and export it. Then that person can take the benefit of this notification 40/2017. What he can do under that is he can tell us that please charge me only 0.1%. If it is an IGST, 0.1% IGST. If it is a CGST and SGST transaction, it will be 0.05% CGST plus 0.05% SGST. In all, the total GST I would have charged on the transaction is 0.1%. Am I right in charging only 0.1% to that person? Yes, you are right, as long as that person gives the requisite documentation, which is governed by notification 40/2017. So what am I supposed to do? I am supposed to do the collection of documents which are, one, to prove that he is a person who is a merchant exporter, that he is registered with an export promotion council, his registration with the export promotion council, and then the proof that he has exported the goods, and that too he should have done the export of the goods within 3 months from the date of my invoice. It cannot be beyond that. Within 3 months from the date of my invoice, he should have exported it, and that shipping bill copy he is supposed to provide to me. In that shipping bill, my GST number, my invoice number shall find a place. Only then the transaction is allowed to be 0.1%. If we are not in possession of these documents, then the transaction done at 0.1% will be disallowed at a later point of time by the officers. At that time, we will have to pay 18%. The differential of 17.9% will become the liability or the expense to the client. Hence, to avoid this documentation shall have to be checked and shall have to be maintained separately. We can always pull out all the merchant exporter transaction done during the year by just going through their GSTR 1.1%. Seek documentation, keep it in a separate file. I think we are covered to that extent with respect to the financial year closure. The next documentation is with respect to the petroleum industry specific, where notification 3/2017 states that somebody is in the business of mining for petroleum products, and for them, if you are supplying any plant or machinery which is required for the purpose of mining or refinery, then the special notification says GST applicable is only 5% and anything above 5% is exempted. If such a transaction had been done, then from the Director General of Hydrocarbons, DGH, they should have produced a document, certificate saying we are entitled to procure at 5%. That documentation in our hand, we can say you could have billed him at 5%. So generally these transactions are a little tricky because our assessee would have done a tax which is not 0.1, which is not that low. So may not catch our analytical procedure, but we need to have a check on 5% transactions. 5% outward supply, if it had been done by the taxpayer, that will certainly be falling under one of these categories, that is either petroleum products or the next one that I'm going to discuss, which is the person who is into research and development. It could be a university, it could be a department of the government, it could be the Army, Defense Research and Development Organization, or it could be ISRO. When they procure from us and it is meant for the purpose of research, they can give a certificate, and the certificate cannot be given by anybody. It has to be given by an officer who is mentioned in notification number 47/2017, depending upon which organization. If it is a university, a certain officer not below that rank. If it is a defense research and development organization, an officer not below a particular rank, they will have to give a certificate that these goods are being procured only for the purpose of research. And once a certificate is obtained, we could have billed them at 5%. So deemed export transaction, full value will be there, but that transaction is entitled for refund. Hence, we need to have the documentation. Merchant export transaction, 0.1% would have been only shown as outward liability. We need to have the documentation. Petroleum or research and development is the ultimate use by the person who is going to procure from us. Then they need to provide the appropriate documentation, which we need to have to prove that the 5% transaction is in order. So notification based documentations would be these. And then we also have the specific documentation in respect of zero rated supplies. Now in GST, the zero rated supply transactions are only two types. One is supply as an export. The other one is supply to an SEZ, Special Economic Zone. If I am making supply of goods as an export, then I must be in possession of shipping bill. That is the documentation that is expected to be maintained. If I am supplying to an SEZ, whether it is goods or whether it is service, does not matter. But my supply to an SEZ should be acknowledged by the SEZ by way of them giving me a certificate, which is SEZ procurement from DTA, and SEZ procuring from the domestic tariff area. They need to give a certificate to that effect. Earlier, prior to 2019, we were obtaining the manual chapa or the seal on the face of the invoice from the SEZ officer. But now the systems have been put in place where the SEZs are supposed to report what are the things that they have procured from the SEZ, the DTA, and the invoice number wise, supplier wise, they are supposed to make a report. So obviously they will upload our data as it is procured from a DTA supplier. That certificate shall have to be obtained as a proof that we have made supply to an SEZ. Without this, our GSTR 1 alone will not stand as an evidence that we have made supply to an SEZ. And this is very difficult if it is a service. If it is goods, yes, there is a possibility to prove with a corroborative evidence of e-way bill, but this is not at all possible if you have done the transaction in terms of a service rendered to an SEZ. We will never be able to prove unless we are in possession of this domestic procurement certificate given by the SEZ. Hence, please look out for this documentation for all those supplies made to SEZ. And if it is export of goods, yes, obviously shipping bill is going to be our corroborative document. And if it is going to be export of services, zero rated, as I said earlier, your realization of convertible foreign exchange will be the ultimate proof. That is the documentation which will be required to prove that we have made a supply only to a person who is outside India and earn foreign exchange on the transaction. The other precautions that we need to take with respect to documentation in the financial closure is look at the non-GST transactions. Now you might wonder, Shankar, why would I look at non-GST transactions? Because there is no question of GST on those transactions. Then what is the need for substantiating with documentation? There is an absolute need, because non-GST transactions, especially in the nature of high C sale, which falls under Schedule 3. For a high C sale, we must have the documentation to prove that we did not do an intermediary transaction. We did only a principal to principal transaction. How do I prove it? Unless I procure from a person who's selling it from outside India and I have a corresponding sale invoice to a person within India, but I do not clear the goods. I only do the buy and sell, and the person to whom I have sold within India, he is going to do the ultimate clearance from customs. For proving this, for proving the genuinity of the transaction, that I have only acted as a principal to principal basis on this transaction, I have not acted as an agent. Because if the department proves that you don't have a documentation, then they will say that you have acted only as an agent in this transaction. By acting as an agent, you become an intermediary. By becoming an intermediary, you are liable to pay GST on the transaction, as it is a supply of service. So to avoid that complication, we must be in possession of this documentation for high C sale. What is it? The document with respect to our purchase from the foreign seller, and what is the documentation that we possess in terms of the supply without physical delivery, the transfer of document of title to goods, as it is contemplated in the Sale of Goods Act. So how did I manage to sell to my customer without taking physical delivery, but there is a purchase and sale? High C sale documentation is ultra important. Yes, what is considered as non-GST will end up being our liability. The other transaction, which is little common these days, is zone to zone transfers. There are people who do transactions from FTWs, the free trade warehousing zones, directly to SEZs. In those cases, it is not a question of GST, because it is non-GST. It is going from one warehouse to other warehouse only. So it is not crossed the customs frontier, hence there is no GST. But to prove that, because it will stand as a sale transaction in my books of accounts. So to prove that it is a non-GST transaction, the appropriate documentation shall have to be maintained. The bill of entry for warehousing and then the zone to zone transfer documents given by customs authorities shall also have to be maintained to prove that I have done the transaction. So identify those transactions that have happened during this year, prepare the documentation or accumulate the documentation and keep them separate, to ensure that there is no additional liability, there is no surprise that comes to us whenever there is an audit by the department. We also know that the documentations are adequate in hand, then there is no question of contingent liability arising. That way, we will also ensure that our audit process has been adequately documented. And then the merchant trade transactions, another famous non-GST transaction. In this case, my invoice would not even be on a person who is within India. Let's say a seller is in Malaysia and the buyer is in Dubai, but I am the person who is buying and selling. So the seller in Malaysia would not know who is the ultimate consumer, and the buyer in Dubai would never know who is the seller. What I am doing is I am procuring from the person in Malaysia. I am engaging a transporter, shipping the goods directly from Malaysia to Dubai. The goods will never enter into India. Now the Dubai person will get my sale invoice, whereas I will get the sale invoice of the person in Malaysia. I will account the sale invoice of the person from Malaysia as purchase invoice, and I'll account my invoice to the Dubai person as my sale. But these two, from an accounting terminology, we can call it as import and export. From a customs or from a GST perspective, these goods never entered into India, so they can never be called as import or export. They are non-GST supplies. But we need to prove that it is only a non-GST supply. I never did any GST transaction here, and I also did this transaction on a principal to principal basis, and I am not an intermediary. To prove that, we need to have the documentation for this merchant trade transactions also. So another requirement from a documentation angle for the financial year that has gone, or that is going to get over. And moving to the next aspect, the checklist as part of our closure of the year, where we need to focus is on the advances. Why advances? Because this will elude our audit process for a simple reason. There is no revenue there. The concept of revenue recognition will never arise, but there is a tax liability that is sitting there, especially if the person who is taking the advance is a service provider. Let's say our client is a service provider. He is taking advance, then 100% on that advance GST is applicable because time of supply says so. As per time of supply, the advance that is taken, he is liable to pay GST. So from the eyes of GST, there will be a liability, but from the eyes of revenue in P&L, there won't be any invoice. Hence, there won't be any tax liability associated with an invoice, but there is a tax liability associated on the advance that is received, which is why I said the advance received register shall have to be maintained on one end, and on every advance that is received during the year, we should take a precaution to find out whether it is for goods or service. If it is for service, the applicable GST should have been charged and that should have been remitted. This check should be done and all those advances shall have to be maintained separately. Why? Because there is another check as a statutory auditor or as a GST auditor we need to make, which is whether the tax that is liable to be paid on advances has been paid is one end, and whether the transaction on which I am paying GST on the advance, whether that has been disclosed appropriately in my GST return. Now, wherein one is supposed to report it in the GST return, in GSTR 1 table 11A is the place where we are supposed to report what is my liability for the month arising out of advances received. And 11B is the place where I'll be reporting how much of that advance is being adjusted in the current month. Now, this is a point where auditors will have to very keenly do an audit or a check, because in the GST portal, there is no restriction. When I mean there is no restriction, a person could have reported advances worth only 1 crore, but he could have adjusted advances worth 10 crores in 11B. Having reported only 1 crore worth of advances in 11A, system does not restrict me. In 11B, it doesn't say you have reported only advances to the tune of 1 crore. I will not allow you to offset more than 1 crore. It will not restrict. Hence, either out of oversight or by mistake, people have done this, where even without an advance being there, they have said we have adjusted against the advance in 11B. So a comprehensive reconciliation of advance is what we need to do. If the client is liable to pay GST on advance, please make a reconciliation as to how much of advance related liability they have, and of that how much of adjustment has been done during the year and how much of advance is being carried forward to the next year, so that next year the adjustment can happen. Likewise, last year they have paid and the utilization of those advances have happened during this year. How much has been carried forward to this year shall also have to be identified and documented. So revenue recognition and the output tax liability will not meet here, but output tax liability that is arising on advances shall have to be documented and will have to be verified. A possible area of miss from the client side, which we need to check. And the other key area for audit, which we need to further investigate as a precautionary measure, is the transactions which generally go by the terminology of adjustments. Adjustments to what? Adjustments to the taxable value or tax value. When an adjustment is being done to the taxable value or tax value, what are we supposed to look into it? We are supposed to look whether it is an upward adjustment. If it is an upward adjustment, I have raised an invoice and subsequently I am raising a debit note. That is the only way in which I can increase the transaction value or taxable value. If a debit note had been raised, certainly it will give rise to additional tax liability. This is very common in case of automobile industries, where there will be retrospective price revisions. Steel industries, retrospective price revisions. In all those cases, the additional tax liability will have to be discharged, and that additional tax liability would be found out only from the scrutiny of debit notes. The other side of the coin is reduction in the value of supply. How will that get documented and how that can be checked is a credit note. A credit note would typically mean that as a supplier, I'm reducing the taxable value, reducing the tax value. that I can do in a credit note, through a credit note, and that credit note, when it is scrutinized, one will be able to find how much of the adjustments has been done by this person during the year and whether the appropriate documentation exists for it. Because section 15 subsection 3 clause B, section 15 subsection 3 valuation talks about two critical things. One is discounts when it is given. Discounts can be allowed as a reduction from the taxable value, but there are conditions in case of post supply discount. Section 15(3)(a) talks about discounts which are given on the face of the invoice, which is allowed. There is no restriction for it. There won't be a credit note for it, but the credit note giving scenario would arise only when we are going in a situation where 15(3)(b) will get attracted. In other words, post supply discount is given. When a post supply discount is given, there are conditions that need to be fulfilled as mandated under 15(3)(b). So those conditions being, it should be identified individually, the other party should have reversed, and it should be pre-agreed. Whether those conditions have been satisfied or not is a check that which we can do as a precaution to ensure that this credit note should not become ineligible at a later point of time. If the credit note becomes ineligible, what happens is immediately the liability will increase. An unforeseen surprise, to avoid this precaution shall have to be taken. And when we speak about debit note, what we need to look at intricate is a debit note is always going to come along with an additional liability. How is that possible? I'm presuming that most of you will be able to access the chat. Now look at a scenario where I made a supply and I've raised an invoice. In January 2020, I made a supply, I've raised an invoice for 1 lakh rupee plus GST. Now what I am doing is, there is a price increase that is accepted by both the parties, and for the price increase a debit note is being issued, and the debit note is issued for rupees 20,000. Now the question is, what is the taxable value and what is my time of supply? If you can access the chat box, the only way of interaction that which we can do is, you can type your answers in the chat box, please. Let me see whether I am able to access the chat box. Yeah, I can see the chat box. So the taxable value here, what is it? What could be my taxable value? My taxable value here is 1,20,000, and while that is very clear and straightforward, the one that we need to be cautious about is, what is the time of supply? The time of supply happens to be January 2020, but I raised the debit note only in May 2020. I knew about this price increase only in May 2020. How can the law say that the time of supply is January 2020? That is how it has been framed. Hence, as per section 12 or 13, whether it is goods or service, the time of supply would fall on the date of invoice, which would make us liable to pay an interest. How much of interest will be liable to pay? We'll be liable to pay an interest considering January as the time of supply. So the due date of January till the date I'm liable to pay, or when I make the payment for this 20,000 rupees GST on that, till that date I'm liable to pay interest. So that is what is the liability which we may not be forced, we may not have foreseen, which we may not even have shown in the books of accounts. Hence, debit notes, please remember, it not just comes with a tax liability, it will always come with an interest liability also. That interest is certain. There is no way to overcome that interest liability. Payment of that interest liability on one end, and second, if it is not provided, make a provision. If it is provided, ensure that it is getting paid. That shall be our responsibility or a precaution to be taken. Further, when it comes to credit notes, we need to analyze the credit notes in terms of whether it is a credit note with the GST or whether it is a credit note without GST. Why should I do that? Because the credit note with the GST is the one where we will have an impact of ITC reversal, so on and so forth. We will see that in little detail when we come to GST or 2-year reconciliation, which is another precaution that I have lined up for today. If it is without GST, I would say there is a lesser complication. Whenever a credit note is given with the GST, either by us or our suppliers to us, what we need to ensure is credit note can be given only for a certain reason. The reasons, what is listed in the law in section 34 subsection 2, whether we are in compliance with that. And as we discussed earlier, whether if it is in the nature of post to supply discount, whether it is in line with section 15 subsection 3 clause B, that requirement. If it is without GST, we simply call them as financial credit notes. They will form part of our GSTR 9C reconciliation. They will not trouble us in terms of liability. But the credit notes with the GST, when we are giving or when we are taking, that is when we have to be a little careful to ensure the additional compliance of section 34 subsection 2 and 15(3)(b). 34(2) says that a credit note can be given only in following three situations. One, when the goods are returned, or when it is a situation of reduction in the taxable value or tax value, or when it is in the nature of deficiency in supply. When there is a deficiency in supply, I can reduce the originally agreed value by way of giving a credit note. So this would technically not come under 15(3)(b). What will come under 15(3)(b) is reduction in taxable value or tax value. That is what is considered to be a discount or reduction in taxable value. So we need to ensure when we look at a credit note, both from purchase angle as well as in sales angle, if it is from purchase angle, what we need to ensure is whether for those credit notes we have reversed ITC or not. When it is from our outward angle, we need to ensure that if it is a with GST credit note, whether our customer has reversed ITC is one. How can we ensure that? We cannot go and look at his books of accounts, but we need to report it in his returns to reflect it in his 2A. So how to do that? Just report it in your GSTR1. That should have been done. Minimum post. And if it is a credit note which is coming under 15(3)(b), all the conditions whether required under 15(3)(b) are satisfied or not. That is what should be a pointer or a check that we need to perform. So debit notes and credit notes, transactions to be further scrutinized from these perspectives. Moving to the next part. The other common area where there is a miss by the taxpayers and later on there is a surge in the tax liability because the department tends to catch is with respect to RCM, reverse charge. When we say reverse charge under 9 subsection 3 is what I am talking about, because 9 subsection 4 has now been restricted only to the real estate industry. 9 subsection 3 is the notified reverse charge, which is applicable both for notified goods as well as services. As a pointer, I have given some of the goods on which this reverse charge is applicable. So if our client has to be, client is a person who has to procure any of these goods, check whether he has paid the RCM liability. Availment of ITC is secondary, but discharge of liability is the primary thing and important thing, whether that has happened or not, that needs to be checked. So if he is into dealing raw cash unit purchases or tendu leaves or tobacco leaves, silk yarn or raw cotton, or he is a scrap dealer who is procuring goods which are disposed by government, in all those cases, he is the one who is liable to pay GST under reverse charge. Whether that has been fulfilled, that liability has been paid, is what we need to check as a precaution. And then when it comes to services, we have a plethora of about 18 different services, depending upon who is providing and who is receiving. I'm just going to give a macro level feeler of those which are common, the reverse charges which are common and how that needs to be handled. Legal services by a lawyer. Now, in this case, legal services by a lawyer, we are liable to pay GST under reverse charge. A very, very common mistake that tends to be committed is legal and professional charges ledger is there, things are booked, this expense is booked, but somehow the IT reverse charge is not paid. And when I say legal services by a lawyer, it includes any services that is rendered by a lawyer which is in connection with a legal thing. So it could even be an opinion, it could be a drafting, it could be verification. But as long as it is a legal service rendered by a lawyer, we are liable to pay GST reverse charge on that. Some people overdo that. They pay for all the professional charges reverse charge and they tend to think that we will be able to take ITC on that, which is also wrong. We are liable to pay GST, then only we can take the RCM paid as ITC. We have wrongly paid the tax, then how can I take the wrongly paid tax as ITC? That is not possible, that is not right. Hence, ensure that all the legal services covered in the P&L are covered under reverse charge as well. And then comes to the other litigative point where we need to be really careful, because we are disclosing that numbers also under the related party transactions. Services of a director of a body corporate, any services rendered by them, the body corporate is liable to pay the GST under reverse charge. So what we need to ensure is services received from a director by a body corporate where there is a respite given by way of circular number 140, which has clarified abundantly that if the director happens to be an employee on that service as an employee, where we do the income tax TDS under section 192, there is no reverse charge, because that is not even a supply. But having clarified that for the payments made under section 192 TDS under income tax, there is no GST. They have made everything else getting covered under reverse charge, because the other deductions could be 194J, 194C, 194A, anything, where the services are rendered by the director. When we make the payment to the director, the body corporate is liable to pay GST under reverse charge. So 192 TDS attracting payment only enjoys the immunity. All the others are open and subject to reverse charge. Hence, please check as a precaution whether it has been discharged or not. Eligibility of ITC, as I said, is secondary. Now, discharge of liability is the primary objective. Sponsorship services. Typically, this gets missed. People do not pay this RCM. Where to find it? When we are finalizing, we need to look at the advertisement expenses, or we need to look at any kind of donations or charity, because there also they could have sponsored an event which is organized for the benefit of hearing impaired. But at that time, they would have booked it as donation, but technically it is not a donation, it is a sponsorship fee. On sponsorship fee, the recipient is only liable to pay under reverse charge. Ensure that that is getting comprehensively covered. And then the other common reverse charges that we come across, GTA. Any freight that hits our P&L, we should be able to substantiate whether it is a freight on account of road transport. If it is on account of road transport, we are the ones who are responsible to pay GST under reverse charge within the framework of exemption of 750 rupees or 1500, as the case may be. Check whether in all those cases GTA, goods transport agency services related RCM, has been discharged. And whenever I am importing goods by sea, ocean freight would attract RCM. That ocean freight related RCM, whether it has been paid by them or not. Now the matter is pending before Supreme Court. Supreme Court is yet to give a judgment on that. The judgment is reserved. All the arguments are over. Let us wait and see how the judgment comes. But for the time being, as the law it stands today, ocean freight RCM is still applicable. So whether the ocean freight is identifiable separately or not is a question. If the ocean freight is identifiable separately, paid by an importer in India, on that ocean freight is liable to pay GST RCM at the rate of 5%. If the ocean freight is not identifiable separately, it has been procured on CIF basis. Then on that CIF basis value, take 10% as a taxable value, and on that pay 5% is what has been prescribed. So whether that liability has been discharged or not under reverse charge is another pointer to check. Any other import of services apart from this ocean freight, there are various other services for which, as I said earlier, 15 CACB would have been given, payments would have been made. Check from that whether we have actually made the reverse charge payment whenever it is liable, because not all the foreign currency services payment would entail us to pay a reverse charge. There are situations where there may not be. Hence, that need to be checked. And copyrights, publishing company or an author. If the author is not registered and he is not ready to pay GST and forward charge, then the reverse charge liability is cast on the publisher, whether they have paid the reverse charge liability. That is another pointer to check to freeze the RCM related liabilities. The other common RCMs that can arise is security charges. Security services, whenever it is received from a non-corporate by a body corporate, we are liable to pay GST under reverse charge. And the most missed out or a nagging reverse charge is renting of motor vehicle, passenger related motor vehicles. When we take them on rent, we are liable to pay GST under reverse charge, where the person who is giving it on rent is charging 5%. In those cases, we are liable to pay under reverse charge. When we pay under reverse charge, we get into a tricky situation, because it is not like other RCMs where I can generally say I will pay the reverse charge, but at least I'm entitled to take ITC. But the renting of motor vehicle by and large happens for a vehicle which is lesser than 13% seating capacity. In those cases, we will have the liability only to be performed from our end. We may not have the ITC benefit. Hence, to ensure that this liability is being fulfilled, it is good on the part of our audit procedure, because since there is no ITC, you do not pay, you actually are incurring an expense. If you pay at a later point of time, including the GST, that expense or the GST expense will hit the P&L at a later date. To ensure the matching, as well as what is pertaining to this year has been booked in this year, this renting of motor vehicle related RCM place to scrutinize and see whether the appropriate liability has been discharged. And then the other hidden area from where a sudden liability can crop up is with respect to this concept of letter of undertaking. That is one innocuous document. Now, for this letter of undertaking, I have got two kinds of preparations. One is forward looking and the other one is retrospective. Retrospective thing is, you would have already given an LUT last year. Whenever we are giving an LUT, I think in any chartered accountant office, we will agree that that is one of the easiest filings that can happen in GST. Matter of 2 minutes, we can complete it. Just need 2 witnesses, put the 2 witness name, file it, it's over. But what we are agreeing as part of the LUT, that undertaking that which we are giving is important. The undertaking that which we are giving in case of exports, especially of goods or services, is in case of goods, we are giving an undertaking that the goods which I am exporting without payment of IGST, I will ensure that the goods are dispatched from India within 3 months from the date of invoice. And in case of services, we are giving an undertaking that any export of services without payment of IGST, I will ensure that on those service invoices, I will realize the money in convertible foreign exchange within 1 year from the date of invoice. Now, these are the two important undertakings that which we have given, which can give rise to a liability. How? What if we do not comply with the undertaking that we have given? Let's say our goods have been invoiced for export, but it has not been dispatched within 3 months. Then what happens? Rule 96A will come into picture. I have export debtors which are outstanding for more than 1 year. We are directly getting attracted under non-compliance of LUT condition. Rule 96A will kick in. So in both these cases, how does Rule 96A kick in? I have told you. What does Rule 96A have in store for us? It says within 15 days from the expiry of that period, let's say 3 months or 1 year, as the case may be, within 15 days of the expiry of 3 months or 1 year, we are supposed to pay the IGST with interest at the rate of 18%, because I gave you the option to do the zero-rated transaction without payment of IGST, provided you fulfilled the undertaking, the condition that you have accepted. If you do not satisfy the condition under which you have taken the undertaking, then you are liable to pay IGST. So the 3 months expiry or 1 year expiry, we are liable to pay IGST with interest. And this interest is to be calculated from the date of the transaction, because that date you became liable to pay GST, but the government allowed you to do it without payment of IGST because you gave an undertaking. Now that the undertaking condition is also breached, we go back to square one, where our liability will be frozen on that date. So when we do an audit, this condition has to be verified. There could be situations where we will see export invoices outstanding for more than 1 year, export of service invoices that I am speaking about. If it is outstanding for more than 1 year, then what is our responsibility? Our responsibility is to report that this liability is certain, you are liable to pay IGST. You are liable to pay interest on the same. That has to be quantified, accounted, and reported. The same shall apply for goods also. So this is one hidden liability. This is one surprise or a shock that can come out after the audit is over, only when the department does. So we should not cut a sorry figure without providing for it. This is not going to be a contingent liability if the time limit is already breached. Because even if you are going to know that the 1 year time limit or 3 year time limit is going to expire after the closure of the financial year, but before signing the audit report, then we are supposed to take that into consideration as well while finalizing the books of accounts. Hence, please bear that in mind. This rule 96A has had huge impacts in case of organizations. And rule 96B is also something which has a similar impact on a transaction where we may not be even suspecting that there is a GST impact. What could that be? Rule 96B, which was inserted from March 2020, stated that in case of export of goods, till the time there was no condition, till March 2020 there was no condition that the forex should have been realized. But they inserted this rule in March 2020 saying, all those export of goods that you are doing, where you are claiming refund, the refund could be claimed either under the LUT route or under the with payment of IGST route. That is up to you. But whichever route that you have adopted, the expectation of 96B is, having staked your claim for refund, you ensure that is the exporter should ensure that he is realizing the export proceeds in convertible foreign exchange within the FEMA time limit. The FEMA time limit is, as per the RBI's master circular, 9 months from the date of invoice. If it is a sale in the nature of export, then within 9 months the money should have been realized in convertible foreign exchange. This condition is mandatorily to be checked for all those people who are claiming refund, either of ITC refund or IGST paid refund on account of export of goods. This is an innate condition which is sitting. Again, a surprise or a shock can come out of this, because the importance of this rule is something which I wanted to highlight. This rule, they felt it is so very important that it has now been upgraded into a section. It has now been added as a proviso to section 16 subsection 3 of the IGST Act. So the importance is felt that it is being kept as a rule may not attract many people's attention, so they have upgraded it into a section as a proviso, making people know that the government intention to check such a transaction. So the present situation, how are we supposed to devise our audit program? How are we supposed to check this? Is look at those clients who have claimed export of goods, who have done export of goods. The next question that we need to ask is whether they have done the export of goods and claimed the refund or not. If they have claimed the refund, then it is mandatory on their part to prove that the forex is realized as per the conditions laid out by 96B, which is now section 16 subsection 3, because 96B, what is converted into a section, has been notified from 1st January. If I have done exports, I have not realized foreign currency, but I have not also asked for a refund from the department, then forex realization is not mandatory. Hence, we need to identify and go by this decision-making criteria whether we need to further check the transaction and ensure that adequate provisions are made if the money is not collected. Because with the payment of IGST route is the common susceptible route. People get the IGST refund moment it matches with customs, but later on nobody checks whether for all those invoices for which they have claimed the refund, they have got the payment or not. If they have not got the payment, later on we will get a notice saying that so much of forex has not been realized by you on account of these invoices, but you have claimed the refund. Now pay me the refund back with 24% interest. It will be a huge hit to the P&L or a shock. Avoid it. Take this precaution. Verify the transaction through this filter. Moving further, the next discussion, the next few minutes we are going to spend discussing about the ITC element, the ITC life cycle, and how it has changed over the period at 21-22, how critical is our ITC related focus or preparation is what we are going to discuss. The first thing is the identification of how I become eligible. What are the things that make me eligible? One, I need to check whether all the ITC that I availed is satisfying the condition that is laid out in section 16. And then I need to check whether even if it becomes eligible under section 16, it is not blocked by section 17. Second filter. The third filter that I should put in place is it should match. It should match with the return contemplated under section 38, which happens to be 2A, and in case of 21-22, I would say 2B. So take that 2B into contention and do this matching. And that matching also is governed and restricted by Rule 36 sub Rule 4, which says you cannot exceed a certain percentage. It has to be absolutely matched. And from 1st January 2022, there is no room for additional credit. Only what is matched can be availed. 16.2 AA has been notified. The amendment to section 16, subsection 2, clause AA, which states that only matched credit can be availed, has been put in place from 1st of January 2022. Hence, for the first 9 months only, if at all they had taken some benefit under Rule 36 sub Rule 4, that could have been taken. So we need to go through these three filters, whether it is eligible, whether it is not blocked, and whether it is matched. Then only it becomes my eligible ITC. So my ITC has to go through these three filters. The life cycle of an ITC is, or can be said as, three-filtered ITC, three-layer filtering. Then only I will know, or I'll be able to tell what is my eligible ITC. Once we get this ITC straight, in terms of identifying, only after going through these three filters, we have availed the ITC. Now, the next thing that one has to do is look at the GSTR 2A reconciliation. Are you able to hear me and see my screen? Team ICAI, can you confirm whether you are able to hear me?
Hello, sir.
Sorry, sir.
You're audible.
Am I audible? But my screen doesn't seem to be moving. That is what I wanted to check.
You might have passed the screen sharing, but can you stop
Okay,
the
now
reach?
are you able to see my screen?
I am seeing the ITC cycle under
Yes, sir.
input tax credit now.
Okay. Now input tax credit you are able to see?
Yeah, I can see it, sir. I made you organizer also so that if there's any question pop up, you can see. If not, sir, I'm
Okay.
compiling this. We'll take it up at the end. No problem.
Fine, sir. I'll continue with this because suddenly I could not see my screen moving. That is why I called you. Thank you.
Okay.
We'll continue with our discussion. In the ITC part, the next element that we are going to see is the 2A reconciliation, 2A or 2B, whichever we want to choose and whichever we are going to reconcile, because 2B reconciliation was by and large applicable for the whole of this year 21-22, I would say. Hence 2B would be the more appropriate reconciliation tool. If we are taking that, what is the mistake that one should not have committed, or if it had been committed by the taxpayer, that we should clarify? The precaution to not have committed the mistake that we should ensure is whatever appears in my 2A is not my eligible input tax credit. My 2A has all the credit which is either not pertaining to me, or which is ineligible, or which is wrongly reported against me, and then only I have got my eligible input tax credits which are reported against my name available in my 2A. So what is available and appearing in my 2A is not directly eligible for me as input tax credit. I need to go through and find out what is appearing in my 2A, whether it is actually eligible, whether it is wrongly reported against me, or ineligible, or blocked credit. We may never know. Hence, analysis of that ITC which is appearing in my 2A also helps. And here I can step a little ahead and give you a suggestion as well, because some of the departmental audit proceedings I have seen it happening, which is they take our 2A and further scrutinize in terms of what are all those which have been reported in my 2A but which we have not accounted in my books of accounts. They are asking details of those transactions. Now, in what way it is relevant, how is it correct, I don't have an answer, but department officer says no, that is how I want to ensure that whether you are reporting properly or not. So for that, the officers are seeking the data that is available in 2A, and then from there they are doing a reverse calculation. Hence, reconciling 2A from the point of view of books of accounts and checking whether everything is appearing there is one part of the reconciliation. Second, whatever is appearing in my 2A, whether it should have ideally ought to have appeared in my books of accounts is the other check that one has to do. That other check will ensure that there is no surprise, there is no wrong reporting by somebody which has resulted in accumulation of more invoices against my name in GSTR1. Because we did come across one of the bigger cases in India where penalty was levied on the recipient just because he did not report excessive ITC being shown in his 2A. Now, why did that become a crime or something which is punishable with a penalty? Is because the other person has misused his GST number to report. They never made any supply to them. That is, the person who has raised the fake invoices never made supply to this genuine buyer. But they reported it in their GSTR1, it came to their 2A. But these people also ignored it because they thought somebody has wrongly reported it. But the quantum was running into crores. So when department caught out of this person, they said, why can't I levy penalty on you? Because you never highlighted this as a problem to me. So that is one scenario or one situation where we should not be caught. Hence, ensure that whatever is appearing in my 2A is also reverse checked, at least on a broader level, to ensure that something which is unrelated to me is not staying in my 2A. If it is staying there, an appropriate disclosure is made or reporting. As I said, in this case, some extraordinary amounts are being reported against me, then immediately bring it to the notice of the officer by way of writing a letter to them or a mail to them, bringing it to their attention. At least by doing that, we'll be able to protect the assessee by saying that we were not party to that mistake, or whenever we found the mistake, immediately we have highlighted to the department. The next aspect in this input tax credit that one has to see is the 2A credit notes. In GSTR 2A, not just invoices are important and critical, the credit notes are also equally important and critical. I need to see where the credit notes have been reported by my supplier, whether I have reversed the corresponding ITC or not. Why? Because if you are not reversing, to that extent you will be made to reverse in the future date. But I never received this credit note formally from my supplier. Then why should I reverse? If that is the case, take the precaution. highlight that credit note to your supplier immediately and tell him, why have you raised a credit note? Because similar to invoices, credit notes can also be a wrong credit note reported by my supplier can also appear against me, or a wrong credit note reported by a person who's not even my supplier can also appear against my name in GST or 2E. If that happens to be the case, it is my responsibility to highlight. On the other hand, if it is a genuine credit note raised by him, which I have physically not received, but it is a genuine credit note, then I am duty bound to reverse the ITC. So that hit of reversal, maybe with interest or without interest, I would have identified only if I had scrutinized the credit notes which are staying in my 2A. Hence, one more point of check that we need to do is credit notes which are appearing in our 2A. So moving further, what we need to see or critically look at is the interest liability. There could be delay in payment of tax during the year, which we are identifying as part of our audit when we are closing the financial year. What we need to check is how much is the interest liability. And here, in the last 1 year, two critical things have happened. One is a retrospective amendment that has already been notified from 1st October 2021, but retrospectively applicable from 1st July 2017. The second important amendment has been proposed in this finance bill of 2022 with retrospective effect again, but that is something which is going to come only in the future, but that is going to come with retrospective effect. So both will have a bearing on the quantification of interest liability on account of delay in payment of GST or reversal of GST, which we are going to prescribe as part of our audit procedure after completing the audit or financial closure. Here, I want to highlight the importance of this amendment, which had already been notified under 50 subsection 1, the proviso. The essence of this amendment was that we are liable to pay interest only on the net liability. We are not liable to pay on the gross liability. That is the essence of that amendment. But there are very, very intricate things in that amendment, which I wanted to highlight by way of an example, which is liability of a particular period, April 2020. I have reported in the month of April only, in the April 3B only, but April 3B, I have filed it belatedly. This is situation 1. April 2020 liability, I have not reported in the April month 3B, I have reported in any other month's 3B. Or April 2020 liability, I have not reported at all. Department has issued a notice, and in pursuant to the notice under section 73 or 74, they are collecting that from me. In these 3 cases, how will this net interest liability will work is what I wanted to share. April 2020 liability shown in April 2020 return, but that is reported belatedly. That is April 2020 return is filed, let's say 10 days delay. For the 10 days, you are liable to pay interest for the delay, but that interest is only on the net liability. To the extent of ITC that is available, you don't have to pay interest. You need to pay only on the cash portion if it is there. But in the other 2 situations, a particular month's liability not reported in that month, reported in any other subsequent months, or a liability which is never reported, which is identified by the department by way of notice, and pursuant to that only we are paying. In these cases, though you might have enough ITC in your books of accounts, in your electronic credit ledger, notwithstanding that, we are liable to pay GST interest on gross liability only. This is the very important takeaway from this amendment to section 50 subsection 1, retrospective effect. So please provide interest liability accordingly as per section 50 subsection 1. Now let's focus our attention to the other interest arising situation. In the 45th GST Council meeting, which had happened in September this year, it was proposed that 50 subsection 3 will be retrospectively amended, which has been fulfilled by way of proposing this as a retrospective amendment in the Finance Bill of 2022, wherein the key thing to look at for us is that whenever ITC has been wrongly availed, The current 50 subsection 3 states that you are liable to reverse it with interest at the rate of 24%. Mere availment would make me liable to pay interest is the current scenario. But what has been proposed is if it is availed and utilized, then only interest, and that is also something which is going to be not 24%, which is going to be only 18%. This is what has been promised in the GST Council meeting. In the amendment, it has been proposed as 24%, but I am very sure they will reduce the interest by way of a notification from 24 to 18. So this is the first part. ITC that is wrongly availed and utilized, then only we are liable to pay 18% interest. ITC that is wrongly availed but never utilized, just you need to merely reverse the ITC. There is no need to pay any interest. Many of us would have this as part of our finalization process, because without matching client would have availed, or some of us would even be carrying forward a transition credit, which is now becoming liable for reversal. In all these cases, if the ITC had not been utilized and we know that it is wrong, then simply reverse the ITC. There is no need to pay any interest. But if the ITC wrongly availed has been utilized, to the extent of utilization, interest liability will arise. But the question that is not addressed so far, which I am sure will become a point of discussion in the days to come after this retrospective amendment comes to picture, is what if I have wrongly availed the ITC? The error in availment is not with respect to the amount, not with respect to the supply. The error in availment is with respect to the head. Instead of availing CGST, SGST, I avail IGST credit, or vice versa. What will happen? In those cases, how will I prove that I have not utilized the ITC? Because as per the offset mechanism proposed under section 49, IGST is to be first utilized, then only CGST and SGST. In those cases, I will not have IGST credit balance, but I will have overall ITC balance. Will the department consider the overall ITC balance and say I have not utilized the ITC, or will they consider headwise and say that IGST credit you are wrongly availed, but your IGST balance has become zero? Though overall you have got enough ITC in CGST and SGST, please pay interest on the IGST portion. Is that the stand the department is going to take? Is something which is still not clear. Hence, keeping this in perspective, interest provisions shall have to be made. So that is the precaution that we need to take while finalizing the accounts. If we do not want to make that interest provision in the books of accounts, at least as a contingent liability, that shall have to be disclosed. So that disclosure shall have to come because of this interest. And the other aspect that I wanted to bring about is the general compliances that we need to check. One, please get into their GST portal and check for all those notices and orders happened during the financial year, because some of the assessees are not even mindful of the notices that they have received. They've not even seen it. They do not know. Sometimes what happens is the notice has been given and subsequently no reply has received, ex parte order has been passed. That order now would be pending for appeal, or some of the cases even the appeal timelines would have expired. Identify those, provide for those, or take efforts to contest. That is the next step that one has to do. So notices and orders against the taxpayer on the portal, check has to be made. The next one is e-wayable contraventions, if any, has been committed by the taxpayer during the year. That documentation, that information shall have to be obtained from the taxpayer, so that e-wayable related contravention, what is the amount of tax paid, what is the amount of penalty paid till 1st January 2022. 100% of the tax, 100% of the tax as penalty. So 2 times we are paying. So the tax that is paid shall be offset against my liability. Only the penalty will remain as an expense if I agree. If I do not agree with the department, then I have to file for an appeal and see whether the penalty paid can be taken as a refund. From 1st January 2022, section 129 has been changed to the effect that the amount of 2 times the tax involved in the transaction that I pay goes only towards penalty. There is no tax and penalty, there is only penalty. So this amount I should have paid, and when I have paid, it will have to be decided whether I'm going to contest it or not. Because if you are going to contest that claim of penalty, then that 2 times amount paid need not go to the expense. But if you are not going to contest, the penalty that is paid shall have to be taken to the P&L as an expense. So e-waybill related contraventions, how the notices have been, whether the notices have been received, whether if the notices have been received, how they have been disposed, the liability has been expunged, whether by way of DRC 03 or whether the officer has given a demand in DRC 07 which has been offset by way of payment. All that need to be identified. Yes, this will become a liability which is known at the time of audit but was never taken care. That should not happen. Hence, we need to check this also as a general compliance check. And DRC 03 reconciliation, because last 1 year we have all got used to the concept of paying the liability other than the return by using a DRC 03. If we have got used to that and we have made the payment of liability through DRC 03, we need to identify how much of those DRC 03 paid liabilities are pertaining to this year and how much is pertaining to earlier years. That reconciliations we should start preparing, start maintaining in the days to come. Because DRC 03 would have been raised in 21-22 financial year, but that may not be necessarily to pay off a liability pertaining to 21-22. It could be to pay off a liability for an earlier financial year as well, for which the GST audit would have got over only in this year. Hence, the DRC could be dated to the earlier years. A detailed reconciliation of DRC 03 would be required to be maintained as a precautionary measure. And any departmental audit has happened on the taxpayer or not. If it had happened, and how the departmental audit related observations have been dealt with, whether any DRC 01A has been issued by the officers. If DRC 1A has been issued, then that has to be reported as a contingent liability. How much of it has been accepted by the taxpayer, that should have been paid. How much however is not accepted, that is a liability for which show cause notice has not been issued, but we know on the date of 31st of March that there is a DRC 1A pending that needs to be brought into books, either by way of a disclosure or making a provision. So looking at the taxpayer and asking them whether any departmental audit has happened and how it has been dispensed, collecting the evidences and documents would also form part of our financial year closure precaution. And the next aspect is from 1st April, the numbering series has to be reset. So if you are also giving that advisory to the client, we should tell them that they ensure that the 16-digit numbers are reset so that we don't have a problem in the 2A matching or 2B matching of our customers. They should not report that you are continuing the same series or you are starting it again, then use a different notation. All that should be resolved. And then for all the other documentation, including delivery challans, if the company has a practice of resetting, they should reset, including the receipt vouchers or the payment vouchers or the refund vouchers or self invoices, delivery challans, all those documents which require a numbering. If resetting is part of the practice of the organization, it must be done. And all those reset numbers during the year also, whatever the documentation numbers that they have utilized for the particular month, they should be reporting it in GSTR 1 table 13. People are not appreciating the importance of GSTR 1 table 13 because even if the details are not given in this table, it gets accepted. But it is very critical to fill up this table because that ensures completeness. One of the key check in an audit is correctness and completeness. What is the list of all documents that these people have transacted during the month? An auditor will be able to know from table 13. And that can be used as a defense to save the taxpayer also, saying that I have never raised anything beyond what has been reported in table 13. So from both perspectives, as a precaution as well as to serve as an evidence, corroborative evidence, this table 13 has to be filled up properly. For doing that, documentation numbers during the year, whether it is reported properly, and from 1st of April at least, if something has been missed during the year, we always have room for improvement, which should be carried out in the next year. And the next aspect that we need to advise to the taxpayers is, if you are a composition dealer intending to go for composition scheme, the options are open. Go file your options in the GST portal. And if you are a person who is entitled for a QRMP scheme, That is, your turnover is up to ₹5 crores, then you have an option to choose whether you will file the returns on a monthly basis or on a quarterly basis. If you are choosing to file on a quarterly basis, then again you have an option whether to go for IFF or not. If you go for IFF, you need to pay tax on a monthly basis, which could be 35% of your previous quarter's liability or self-assessed tax. Or if you are choosing not to do IFF, then you can pay it on a quarterly basis as well. See whether which option the assessee wants, and accordingly the assessee can opt for that option, and that option is open for the next quarter. And very important thing about this QRMP scheme is opt out. Somebody might want to get out of the scheme because they have crossed 5 crores or they don't find this very attractive. For that also the option is available. And the QRMP scheme, another appreciative thing that has happened is that QRMP scheme is GST advice. So in this state, I can opt for quarterly. In the next state, for my same GST distinct person registration, I can opt for monthly filing. That is open. So accordingly, the decision will have to be taken. And the next aspect is e-invoicing. Check as a precautionary measure that the client has crossed 50 crores turnover, because the 50 crore limit in the last 3 years is the thumb rule which has been established for making a person come under e-invoicing. 50 crore turnover in the last year, any 1 year I cross 50 crore, then I become liable to e-invoicing. And that e-invoicing, if it is applicable, advise the taxpayer to start off with e-invoicing from 1st of April if he had crossed the turnover of 50 crores. And this e-invoicing is mandatory for all the tax invoices, debit notes and credit notes, both for B2B as well as export related transactions. Because many people tend to think that export is not B2B. Why to raise e-invoicing? No, export related transactions also are covered by e-invoicing. Only B2C transactions will, as of now, will stay away from e-invoicing requirement. So if the turnover has crossed the threshold, advise the client to get into the e-invoicing option, and then there educate the client in terms of what are the transactions that would attract e-invoicing. Because ultimately, what we need to do is reconciliations. GSTR 1 versus 3B and the amendment to section 75 subsection 12. This is one of the key change or challenge that is in front of us. 1 versus 3B, if there is a difference, that amount is considered. For example, 1 is higher liability, 3B the liability is shown lesser. The differential amount of liability is deemed to be a self-assessed tax. What if it is a self-assessed tax? If it is a self-assessed tax, the department need not issue a notice. They need not pass an order for recovery. They can directly come for recovery. That is what is the power that has been vested to the department by the Finance Act of 2021, which has been made effective. This particular provision has been made effective from 1st January 2022. So as small as my GSTR 1 versus 3B reconciliation not happening or not matching, I'll become liable. Immediately, they can go for recovery. The other reconciliation that one need to look at is GSTR 1 versus e-invoicing portal. GSTR 1 versus 3B already discussed. GSTR 1 versus e-payable reconciliation. GSTR 2A or 2B, as the case may be, with my ITC registers. These are the other reconciliations that one has to go through. So reconciliations is the key to compliance in GST. Once we are able to do these reconciliations, we'll be able to satisfy ourselves that numerically data is fine. And the qualitative analysis in terms of documentation and maintenance of registers that we discussed in the earlier part of our session, if those are there, both qualitatively as well as numerically, the reported numbers are true and correct. And that is what is expected out of the job that we do. Hence, looking at what all the things that have been discussed broadly, the precautions and the pointers to probe further, when we do, we'll be able to certainly cut on those shocks or surprises and be able to tell that there won't be any additional liability, or there cannot be any additional liability on account of such checks and precautions that have already been carried out. So that is all with respect to what I had in my mind for today's discussion. So what I'll now do is I will hand it over to the organizers for taking up the questions. And before that, I'll thank all of you for your patient and effective hearing. So over to the team ICAI for taking up the questions.
Sure, sir. So we have compiled 1 minute. So I just share my screen. So
Sure, I'll stop sharing just a moment.
Yes, sir.
Yes, I stop the sharing the screen.
Yes, I'll take the right one. Screen visible, sir?
Yeah, it is visible. Just a moment.
So you can first question from me.
Yeah. Okay. Question for cash unit. What if the supplier has raised invoice and the client has paid GST? Whether department still asks the client to pay again? Sir, this is in case of cash unit procured from an agriculturist. If that is the case, if the agriculturist is a registered person and is charging GST, that is a surprise in the first place. But even if he has charged, if it is procured from an agriculturist, we are liable to pay at a reverse charge. Him charging doesn't exonerate us from the liability to pay under reverse charge. So if it is a case falling under reverse charge, we are liable to pay under reverse charge only. Second, how about the RCM applicability for cab services, which is what I think I discussed on the RCM of renting of motor vehicles, which are passenger motor vehicles, we are liable to pay. By cab services, if you mean the rent-a-cab services, which come under the radio taxi category, I don't think there is any RCM because the radio taxi category will come under 9 subsection 5. They themselves, that is the e-commerce operator themselves, are liable to collect and pay the GST. There is no RCM on that. Reverse charge on director services, is it applicable only for technical director or any director? Any director, so sitting fee starting from. Any payment to the director would attract the reverse charge liability. If a director is a lawyer by profession, does any payment to him from the company attracts reverse charge? I would say yes, because from both the angles. Legal services by a lawyer attracts reverse charge. Notwithstanding that, services by a director would attract reverse charge. In both the counts, there is a liability to pay GST under reverse charge. Please brief on import of services for which RCM is not applicable. Any import of services, RCM is applicable. When I can call something as not an import of services, import of service requires 3 conditions. Supply to be outside India, recipient to be in India, place of supply to fall in India. So, when a transaction can become other than import of services, any one of these conditions is not satisfied. The common thing that I have seen is supplier will be outside India, recipient will be in India, but place of supply will fall outside India. Let's say a warehouse rent for my warehouse located in Europe, I'm paying. Then the place of supply falls outside India since it is a immovable property related service. As the place of supply falls outside India, it doesn't come and fit within the definition of import of service. If it is not an import of service, there is no question of reverse charge. So there is no such service which is called as import of service and no RCM. If it is an import of service, RCM is there. But if it is not an import of service, but payment is being made from India to a person outside India, that can escape reverse charge. FEMA timeline for export realization has been increased 9 to 15 months. Would this be applicable now? I don't think it has been increased from 9 to 15 months. It is still 9 months. 15 months is applicable only in case of exports which are in the nature of stock transfer. If I am doing a stock transfer to my own entity outside India, meaning my own branch outside India or my own warehouse outside India, then 15 months time limit. If it is a sale which is export or export which is in the nature of sale, 9 months only is the time limit. Section 50 subsection 3 amendment. What happens to ITC wrongly availed on which refund claimed? Whether termed as wrong refund claim or otherwise to pay ITC wrongly availed as utilized on claiming refund under this section. It is a situation of double whammy. If the officer finds out that the refund is wrongly given, then he will issue a notice for refund to be given back to the department with interest. Plus, your ITC itself is wrong in the first place. You are supposed to reverse the ITC as well. What is the difference between availed and utilized? When the credit is taken, I don't want to get into the technicalities of availed, availed or taken. All are one and the same in GST. Legally, is there a segregation? No, nothing in the law. It is only what people try to create as a intention of the law. Whether it is availed or utilized, it is, availed or taken, it is equal to booking the ITC. What is utilization? Utilizing it for making the payment. That's all. That is what is utilization. Availment, in roughly we can say depositing of money. Utilization is withdrawal of money. That's it. Instead of money, substitute the term ITC. If my supplier is opting for quarterly filing, then GSTR 2B, it will not be reflected. In such cases, can I take input credit based on the bills received? We cannot take it. We will have to advise our supplier to either opt for monthly filing, or he can go for IFF, invoice furnishing facility. As long as his invoice is not appearing, we do not have a method to take the credit, because 16(2)AA will restrict me from taking the credit of whatever is not appearing in my 2B. Hence, that is not possible at all. He has to become monthly, or he has to go for IFF. Hence, else I cannot take ITC. Can RCM be availed on transport vehicles used for business for movement of goods? I'm not able to understand the question. RCM be availed? Are you asking ITC? Can ITC be availed on transport vehicles used for business for movement of goods? If that is your question, answer is yes, because it is not blocked. But can RCM be availed? Please rephrase the question if you are asked, if you are intended to ask some other question. Tran 1 credit, is there related to capital goods? Can we offset it against GSTR 1 and 60 installments? There is no need for 60 installments. Tran 1 credit is your ITC, electronic credit ledger. You can utilize it for offsetting it against anything. There is no 60 installment that you need to wait. It is readily available for utilization. Whether cold storage charges collected for storing agriculture produce by agriculturists or merchants liable for GST. It depends upon what is the product that is stored. If it is a product that is specifically covered under the exemption notification 12/2017, then yes, there is an exemption. Can stock value be computed from the value of ITC as at the year end? Certainly not possible, because my inventory is all that I have not sold. My ITC balance is the ITC that I have not utilized. There is always a probability that I have purchased and I have utilized the ITC, but the item is still in stock. Unless if you're a trader also, you would have taken ITC for services. So your ITC will look bloated because of service related credits. Though there is one-to-one correlation, still you will have more ITC. Back working from there to find out your inventory will be terribly wrong. If ITC wrongly availed, can department ask for payment and not reversal? If it is utilized, the payment is only the option. If it is not utilized, we can always argue that we will be able to reverse it. Reversal is an option.
This 14th question.
Yeah.
This question.
Whether remuneration to a director of cooperative society is liable for reverse charge. Cooperative society, if it is coming within the definition of body corporate, answer is yes. Reverse charge is applicable. Can ITC be claimed in GSTR 3B if filed after 6 months from the end of the financial year? I am assuming that you are filing for that month after 6 months from the end of the financial year, which means you are filing it after the due date of filing the return for the month of September. You are filing a return which is old. Any return filed after the due date of filing of return for the month of September. It could be for an earlier period also. ITC is not eligible for that earlier period in that 3B.
So those are the questions compiled. Let me just check if there is any.
Yeah.
So, and we'll be sharing the presentation with us, right, sir, so that we can circulate among members if possible. So many minutes for us. 1 minute.
In 2018, service tax credit was taken as input credit in 3B instead of Tran 1. Okay. Service tax period credit. Tran credit you have taken in GSTR 3B instead of taking in Tran 1. Okay. I think there was a specific circular to say that whoever has not been able to take Tran 1 because of a technical glitch, they were allowed to take it in 3B. Subsequently, even the Tran 1 was opened. If you had missed that bus, now at least intimate to the officer that you avail the eligible credit. There are umpteen judgments across various high courts in India making us eligible to take the Tran. So if you still want to stick to the Tran 1 credit, though it is availed in 3B, intimate to the officer. And if there is any objection from the officer, we can legally prove that you are eligible. But that is again not straightforward in the law. It has to be litigated, or if it goes to the next step, you have to take the litigation and then prove the credit. Vendor unpaid for more than 180 days, ITC to be reversed when credit is not utilized, whether interest is payable. Whether ITC to be reversed, yes. When it is not utilized, still interest is liable to be paid because that interest is governed by Rule 37. It is not coming under Section 50, subsection 3. So hence, if you can say that it is coming under 50, subsection 3, then if it is not utilized, we can argue that we are not liable to pay interest on the reversal. Goods supplied between holding and subsidiary, valuation rules to be adopted. Yes, related party. Valuation rules will be called for. It can be invoked by the department because valuation under Section 15, subsection 1 is not possible since there is a related relationship. We have filed GST returns for the period December 2020 in October 2021. ITC has been claimed. Should it be reversed? Yes, it should be. You are not even eligible for it. As I said, due date of filing of return for the month of September. For financial year 2021, September 21 due date is October 20th. Within that time, any return has not been filed. It is filed beyond that. ITC becomes ineligible. Employees personal accident insurance, general medical insurance, certainly you cannot take ITC, specifically blocked by Section 17, subsection 5.
Okay. It seems those were the questions as of now, and maybe if any comes up, we'll share it over me. If possible, time permits, you can answer it over me, so, and we'll share the feedback from there.
We'll do that.
And
thank you.
No, thank you, sir. Thank you so much for your excellent presentation and time, sir. And in chairman and the secretary's absence, I thank you for your excellent presentation. Thank you. Thank you. Thank you, sir.